Hey there, we are live. You're watching Be the Boss of Your Money. I'm Mitch Goldberg. Thank you so much for joining me today. It was a unique day. Let's talk about the market, though. Stocks rebounded. This is the kind of market we're in. 2 weeks ago, we love stocks. Soft landing, Fed's getting close to, slowing down or stopping their interest rate hikes. And very bullish for the market. Last week, no, good news. Well, bad news is not bad news, meaning whenever we had bad news and the stock market, the stock market would go up. Why is that? Well, because the Fed's trying to slow down the economy. So bad economic news is good. So, some layoffs, some slowdown in manufacturing, you know, just general slowdown in the economy. Bad news, but that's perceived as good news because it gets the Fed off our backs. So bad news is good news. And last week, bad news is bad news, where, wait a minute, this is really bad. We're heading into a recession. Jamie Dimon, CEO of JP Morgan, Brian Moynihan, CEO of Bank of America, both came out and said, yeah, our base case is a mild recession, whatever the heck that means. I mean, put it this way, if you're the one who loses your job or if you're the one whose business goes under, the recession ain't going to be so mild for you. However, if you think about a recession as a economic period that is marked with a persistent rise in unemployment, a persistent slowdown in economic activity, declining GDP, and just basically consistent bad news, and earnings, corporate earnings expected to come in lower and lower, that's a recession. That's a bear market. Anyway, now all of a sudden this week, it's the complete opposite. We are back to saying bad news is good news. It's now expected that the Fed could, in fact, be ready to end its interest rate hikes, maybe by the spring, by the summer, by the end of this quarter. It's all over the board, but generally speaking, through the middle of 2023, the Fed is done raising rates. And the next thing we have to look forward to is the Fed cutting rates. So now investors are all bulled up on it. So we keep going from happy to sad with the stock market. And I think the mood swings are enough to drive anybody crazy. And, it's hard to be an investor when you have these kinds of mood swings, unless you are the kind of investor who could ignore all of this. And hopefully most of you are. Like, if you're 30 years old, 40, even, my age, hey, listen, I'm 55. I don't really, I watch the market. I enjoy it. I happen to enjoy it. Believe it or not, during the day, I don't really look at the stock market that much. I hardly ever look because it doesn't make a difference in my day-to-day activities. So the market's down a few hundred, it's up a few hundred, makes no difference. I don't do anything differently. I'm working for my clients. We are investing money. Clients are putting aside cash either out of their portfolios or from earnings for expected financial obligations and to put away money for an emergency fund. That's how we do it. And then we go forward. Of course, I want to be in stocks that have upside potential. I want to be invested in companies that have something unique, earnings, revenues, growth, expected growth, something that makes them special. And don't get me wrong, I have a whole bunch of clients who are just in general index-based asset allocation, exchange-traded funds. They're allocated between large cap, mid cap, small cap, fixed income, international, and that's fine too. It really depends on the client's needs, the client's risk tolerance, the client's wants in terms of investing. Some of my clients only want individual stocks. Some of my clients don't want any individual stocks. So what we do is we cater to the client's needs. But the key is we have to have a relationship where we actually can identify your needs and your risk tolerance, these kinds of things. So that's what we do anyway. I kind of almost forgot to run the intro, but I didn't forget totally. So we're going to run a quick intro. Then we're going to get into the heart of the matter. We're going to talk about what happened today, why the sudden shift back to bullish again. And I think we're going to call it a day. A couple of other housekeeping things to get into. Happy Monday, and here we go. All right. Thank you so much for joining me. All right. So, what happened this week? All of a sudden, we're excited that the Fed could pause its interest rate hikes. Last week, we were worried that the Fed could pause its interest rate hikes because now, wait a minute, what are we missing? Maybe the economy is really weak. We're going into a bad recession, even a mild recession. And this week, we're like, oh, that's good because the Fed could stop raising rates and that'll be good. This just endless mind game, this complete shift from sadness to euphoria, in the words of Billy Joel, is really enough to drive people crazy. So, what kind of investor are you? Are you making moves to because you think, oh, we're going into a certain economic environment like a recession? So, you want to make sure you're doing something to protect yourself by going to cash, right? Or do you want to, selling your investments, your stocks, exchange traded funds, and whatnot, going to cash? Or are you getting ready for the Fed to start cutting rates at the end of this year, maybe early next year, maybe sooner, and the stock market should go up a lot? Some people feel that they have to do something. And when it comes to investing, one of the best things you could do is fight that urge. I've said this before. I want to say it again. Um, you'd think as a financial advisor, I tell people all the time what to do with their money. I actually spend more time telling people what not to do with their money. Think about that. Don't panic sell. Don't make sudden abrupt changes. But if we're having a recession or a slowdown or a bear market, shouldn't I sell and wait for the market to go down and then get back in? Or if we're having a recession, shouldn't I be out of the market and wait till we get past the recession? And I'm going to say no. Uh, if you knew for a fact that the market was going to go lower in advance, that's a different story. But you have no clue. Do you think I have a clue about it? I mean, I have my educated guesses, and I'll I don't want to sound full of hubris here. My educated guess is probably better than most people's. I've been doing this a long time, but I still feel that I'm smart enough to say, don't wait. Don't think like, oh, I'm going to wait till the market goes down, then I'll get back in. I'll wait till the bad times to pass, and then I'll get back into the market. It doesn't work. You don't get back into the market because you're always waiting for a better day. You're always looking for something better. That's what happens. Market goes down, and you're like, you know what? I'm going to wait. I'm going to wait till the market stops going down. And then the market recovers, and you say to yourself, I could have bought when it was lower. I'm waiting till it goes back down again. Then it goes back down again. And you go, wait a minute, it could be going lower. I'm going to wait. Then it goes up again. And you see, no, I'm going to wait. I could have had it lower. It becomes endless procrastination. But over the long term, a trend develops. And since stocks typically go up more in bull markets than they go down in bear markets, ultimately, you're missing out. That's the risk. You're missing out. I mean, it's not a guarantee that the market goes up long term, but we do have corporate managements of companies who are motivated to build great, big growth businesses. And as long as we have that, I think we're good to go with stocks. That's the whole basis of the stock market, right? People who start businesses, the businesses grow, they become bigger, companies go public, then we can participate in the growth of the company. And then as they grow, we get to participate in the upside. American capitalism and the way to get involved is the stock market. It's a pretty good deal. It's something other countries have, but they don't have it developed to the way we have it. It's what makes us great, right? All right. So let's take a look at a couple of things. First, I'll just pop this up. Okay. This is something that's kind of cool. This is what you're looking at is a new website, just a one-page website, so a landing site for Money in the Morning with Mitch Goldberg. Today was my very first episode of my new show. It's a live show. It's actually live. I can't believe I'm doing a live radio show. Well, why not? Right? I do a live stream. So I'm doing a live radio show 9 to 9:30 a.m. every morning. You can listen to it on 103.9 FM. If you're not in my area, I'll stream it. So just right here, you could check out the LI News app or the LI News website. Couple ways to catch the show, but we get into some economic details. We get into some economic know-how, and we get to talk about what's going on in the market, what's going on in the economy, and we talk about other things, personal finance and all that. Really, what I'm trying to do is I'm trying to take this story of what I'm doing with the live stream and bring it to a bigger platform with radio. I mean, that's basically it's. The shows are not identical, by the way, because one's in the morning and one's an evening wrap up. So they are different, and hopefully you'll take the time to watch both. And of course, because I stream them on social media, they're there after that. So even if you miss the streams or the radio show, you could come back a few hours later, a day later, a night later. It's all still on my timeline. But this is the what it looks like so far. Money in the Morning, LI News Radio, a little bit about the show. This is a live link to my website, but this is supposed to say something, learn more about us. This YouTube channel is on my website. I don't know what this is doing over here. I'll have to fix that. And have a question, want to be a guest in the show, get in touch. And underneath that, I want to have something like, you want to become a sponsor of the show, and something to that effect. So I'm just about there. And the website, I don't want to, well, you can't see the website from you, or it's going to be too little. But I can't say the website yet because I have to have it approved by compliance. But it's a work in progress, and we are not far from getting that done. Let's take a look at the major averages. All right. Dow up 254, a nice little continuation from last Friday's rally. NASDAQ up big, up over 2% today. Listen, a 1% move in the major averages gets my attention. 2%, I definitely want to look at that. S&P up 47 points at 1.19%. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. I bet you knew I was going to say that, didn't you? While you're watching this, if you have any questions, whether you're watching it live or in the replay, hit me up in the comments. I love to hear from you, and that's the best part about doing this, and I'll answer your questions. And if you just want to share with me your favorite emoji or just say hi, then go ahead and do that too. And, whenever you leave us a like or, a heart or a wow or an applause reaction, whatever is available to you, depending on which social media platform you're watching from, that helps spread the good word of the show. It helps the show get out there to the rest of your contacts, and that would help us out a lot. So we always appreciate some social media love from you. Thank you very much. Oil was up a little bit earlier today, but 81.62 on West Texas Intermediate. By the way, that's not Brent. Brent is about $88 a barrel. This is for our sweet, delicious, domestically produced crude here in the United States. The 10-year yield at 3.51%. Yields went up across the board. I'll show you that in a moment. The VIX staying under 20. Are we complacent, or are we set up for a big rally? It's like right now we are on the precipice of either a big rally or a big drop, and it's really impossible to tell. All right, but I'll tell you what we can do about it. Yields are up across the board, but the 2-year, look at this. The 6-month is 4.8%, and yet the 10-year treasury is only 3.5%. That is a huge, huge spread between short-term yields and long-term yields, and you are getting compensated to take almost pretty much risk-free rate of return and get a better yield than if you took a treasury with risk and went out 10 years. That is so backwards. It's incredible. This is why the inverted yield curve is such a big deal right now. It's just incredibly inverted. And that is about it. Do you want me to explain what the yield curve is, like inverted, real quick? All right. So short-term rates should be lower than long-term rates, because when you invest longer term, you should get a higher interest rate because you're taking a little bit more risk and you're locking your money up for a longer period of time. So you should get compensated more. But when you're compensated more with short-term bonds and they're paying you more than long-term bonds, it's called an inversion, inverted yield curve. And that's usually a sign of a lack of confidence in the future of the economy. It's also a sign that investors expect inflation to come down. It's a sign that interest rates are not going to go up long-term. And it's a sign, and a reliable, highly predictable sign, that we go into a recession. So that's what the yield curve, inverted yield curve, is telling us. No guarantees that it happens, and right now everybody is watching out for recession, and this is like the most highly anticipated recession ever if we do get it. And it seems to me that investors, businesses, consumers alike take appropriate actions ahead of it So by the time we do get into a recession, we're ready for it. That alone could probably cause a recession. But in any event, when we're ready for it, it's not as tough as it would ordinarily be. And just that is one part of consumer finance, investing, and personal finance that has improved a lot in the public over the last couple of years. I don't think people would have gotten ready for a recession 15 or 20 years ago for sure. Plus, you would have had all the information that you have at your fingertips today. And you didn't really have me doing my live stream and radio show. Okay. So that is about it for today. Thanks so much for watching, and I will see you tomorrow.